Hey there, Tom Berry with ILS Capital here, and I hope that you're really going to get a lot of education out of this next video presentation that you're going to see. This is a presentation I've given probably 5 or 6 times now, and it's on market cycles and how we have been able to use market cycles, even the dips in the market, even the things that a lot of people call bad in the market, to our advantage. So I'll see you on the back side of the video for a little bit more explanation.
My name is Tom Berry. Donald and I started Investor Loan Source, which was our first ILS company. Now we kind of have a family of ILS companies that has grown over the last, since 2014, almost 10 years now. So I get questions a lot because I'm kind of the real estate guy and he's kind of the back office guy. That's kind of our division of duties in this thing, and it's worked really well for us over the years. So as the real estate guy, I get questions a lot from potential investors or really even real estate guys that I meet as I travel around the country. And it's always, what do you think the market's going to do? Right? I see a lot of heads going like this right now. Y'all thinking, okay, yeah, I'd like to know that. So I have a line that I tell people when they ask, what do you think the real estate market's going to do? My line is, it's going to change. Okay? It's going to change, right? Because I don't have a crystal ball. I can't tell you exactly what it's going to do. But I'd like to just kind of share with you our thought process of what Donald and I go through and our team goes through as we're looking at different real estate investments and how we come to the decisions that we come to. Because how many of you in here invest with us in some way or fashion and are willing to admit it? Okay. So half the room, right? So that half of the room that admitted that, you probably would like a little glimpse into our mindset and how we come to the decisions that we come to. And that's basically what I'd like to share with you tonight. I'm going to talk about market cycle investing. This is my favorite topic of all real estate topics. And I talk all over the country on stages of real estate investors and capital fund groups and so forth. But this is by far, I can't walk up there. Okay, got that down. This is by far my favorite topic. So we'll keep the lawyers happy by saying that this presentation is for educational purposes only and is not meant to be tax, legal, or investment advice, right? And it's also not a solicitation for investment. Now that we got all of the legal work out of the way, let's talk about real estate for a minute. Why in the world real estate? You know, there's a lot of things that we could invest in, and I would argue that real estate is probably the most predictable commodity there is. Now, again, we don't have a crystal ball. We can't be exact and time any market, real estate included. But if you think about how real estate works, it works different than other investments. Let's talk about, we've got a lot of farmers and ranchers out here tonight. So let's talk about cattle futures or lean hogs, or we talk about gold or oil or any other commodity. How quickly can you buy or sell those things? Pretty quick? With a click of a mouse now, right? A lot of commodities can be bought and sold with a click of a mouse. And they are. Most things are traded online anymore. And because they're traded online, that allows us to make emotional decisions when buying or selling a commodity. Would you agree with that? We could read a report and go, oh, shoot, I need to get out of that. Boom, I'm going to sell that today. And then a week later go, boy, that was dumb, right? Or vice versa. Oh man, that's gonna skyrocket because of some silly news article we read. So we go online and buy some stock in it, and then 6 months later go, man, I didn't do anything, right? Most commodities can be bought and sold instantaneously, very quickly. And because of that, they're traded mostly on emotion. Now, let's take a piece of real estate, for example. How quickly can you do that? How quickly can you sell or buy a piece of real estate? It takes a minute, right? It takes a minute. It might take months. It might take longer than that. So real estate is typically traded on fundamentals. And I want to be investing in assets that are traded on fundamentals, not on emotion. Does that make sense? I believe because of this, it may explain why more millionaires make their millions in commercial real estate than any other asset class. That's a fact. More millionaires become millionaires through commercial real estate than any other asset class. Because it's predictable. Now, again, not with certainty, but if you watch for leading indicators, you can see which way the trend lines are going. So I'm going to share with you tonight some history. And we're going to start our story in April 2008. And we're going to come from April 2008 to present, and we're going to talk about these market cycles and the ups and downs of different facets of real estate. Okay? So what drives a market cycle? Well, the biggest thing that drives a real estate cycle is really the same as what drives any commodity. Supply and demand, right? That's what drives it. If a lot of people want it and there's very few of it, what happens to the price? Goes up, right? And conversely, if nobody wants it and there's a whole bunch of it available, what happens to the price? Price falls, right? So supply and demand is going to drive the prices of real estate, but we got to dig deeper. What creates supply and demand in real estate? And I've got a little list here, but the number one thing on that list is jobs. Jobs. Where there's job growth, there is most generally real estate price growth. Now, there are other things too. Right now, there's another big one glaring at us on that sheet. Anybody pick that one out? Yeah, interest rate, right? That one drives real estate too, because real estate is typically bought not with cash, but with leverage. So when that leverage costs more, what does that do to the price of real estate? In most cases, and in particularly in commercial real estate, it's going to depress the price. It's going to push it down. And that's exactly what's happening in most commercial real estate today. So what I always say, and what Donald and I always do, is we take what the market gives us. It doesn't matter what we want to do. It doesn't matter what we want to invest in. What we want to know is, what is the market telling us to invest in? Does that make sense? Because the market will give you clues. And I'll share with you some of those clues in our little history lesson. So, April 2008, where our story begins, my wife and I were brand new real estate investors. When? April 2008. Now, just go back there in your mind. Most of you in here, yeah, y'all are going, oh, right? Perfect time to get into the real estate game, right? April 2008. No, it was not the perfect time to get into the real estate game. So we bought this house on Bullfinch Street in Houston, just south of Belfort. Paid $38,000 for the house. It needed fixed up, and we said, we're going to flip this thing. We'd seen on TV all those flipping shows. It seemed easy. These women in high heels walking through these houses can do it. Surely I can. You know, I mean, right? So we buy this thing for 38 grand. We're all in at 100 grand with the rehab and everything, and we're ready to sell it. There was a problem. When I bought the house, I was sure of my comps. I knew exactly what I could sell it for. I could sell it for $149,000. I knew that. Oh, I'd have closing costs out of that, realtor's fees, etc. But at the end of the day, I was going to make a really nice profit. The problem is, from April when we bought it to when we finally got the rehab done, and then got it on the market and listed, and then it got marketed and sold, and then after getting sold, it took another couple months to get it closed. What was happening in 2008 to housing prices? They were going down. So what was happening? Every month I'm sitting down recomping my house and going, oh crap, that 249 is now 139, or 149 is now 139, now it's 129. And I was praying that we could get it sold before the numbers crossed and we would lose money. Okay, true story. We sold the house, we made 10 grand. It's the sweetest $10,000 we probably ever made because we didn't lose money, right? Could have just as easily been a $10,000 loss. We're going home from the closing. My wife looks at Manny and she says, "How do you feel about this real estate thing?" Like, she's my conscience, right? She always gets a good dig, but she's making a point, right? This did not go as you planned, right? This did not at all go as I had planned. And I said, people are losing houses. They're not able to get loans to buy houses. We are no longer a flipping company. We're a rental company. And she's like, "We're a what?" I said, when people are losing houses and they can't get a loan to buy a house, they still have to live somewhere. So we're not a flipping company anymore. This was our very first flip. And it was also our very last flip. And we turned to a rental company. And we went on over the next several years and we built a portfolio of 86 rental houses. Why? Why did we do that? Because the market was telling us to. People still were losing houses. Houses were cheap as could be. I mean cheap. I'll share with you how cheap in a minute. This is a picture of one of our rental properties that we had back then. We were able to buy them for $35,000, $40,000, go in with 20 grand or so, fix them up, and lease them out at really good rental rates because people were having a challenge getting a loan to buy back then. So what did the market need at that time? It needed rentals. It didn't need flips. And with that, you stuck with me, and we still use that lesson to this day. So by the end of 2010, here's what happened. We weren't able to get those houses for $35,000 to $45,000 anymore. All of a sudden, everybody and their brother saw, it's a good time to build a rental portfolio. And now I'm bidding against everybody else in town for these houses, and I'm not able to get them in my buy box. That's a term I'm going to define for you here in a minute because it's one of the keys to ILS and what we do. We always have a very strict buy box. So a strict buy box. Back then, what our buy box for single family rentals was this. They had to be in Galveston County or South Harris County. They had to be within 20 minutes, not miles, 20 minutes in normal traffic from our office. Now, why 20 minutes? Because I found out my staff would not manage that property properly if it was any more than 20 minutes away. My managers wouldn't go out there to check and make sure signs were there. They wouldn't go out and meet potential tenants. My maintenance guys wouldn't go do work orders in a timely manner. So I sold off everything that was more than 20 minutes away from our office. And I said, we're going to only be within 20 minutes. By the end of our first year, we were in 5 counties. I had a lot of selling off to do, okay? But we sold off everything that was not within 20 minutes. And we learned that the hard way. We wanted an all-in cost, that is the purchase and the rehab of $100,000 or less. Now, mind you, this is 2008, 9, and 10, okay? Not today's numbers. We wanted 3-bedroom or more, and we wanted a rent-to-price ratio of 1.8%. So what does that look like? If our all-in cost was $55,000, and by the way, that was our average all-in cost for our houses with the purchase and fixing it up. 55 grand, it had to rent for $1,050. Now, would you like to have a portfolio like that if you didn't have to manage it and mess with the people? All day long, right? Yeah, that's making money. That's making money. Our portfolio averaged 1.8% rent-to-price ratio because we stuck to that buy box. If it didn't meet 1.8, next. But by the end of 2010, they were all next, and I wasn't getting anything bought. So what do? So we looked around and we said, what's the market telling us to do now? Well, the market was telling us to buy apartments. And why? Because everybody was selling them off. And they were selling them off at ridiculous prices. We were able to buy apartment units. This is back in 2010 to 12 now. We were able to buy these apartment units for anywhere from $8,000 a door, which is just unheard of, to the worst deal I made was $24,000 a door. When we started selling those same apartments off, the worst deal we sold was $46,000 a door, and the best was $64,000 a door.
I'll buy every one of them.
Yeah, now those same apartments would go for $80,000, $90,000, $100,000 a door, okay? If we still have them. We don't. So 2010 to 12, we wanted to buy all those we could buy because everybody was selling them. And they were selling them for nothing. Absolutely nothing. We still bought within 20 minutes of our office, all in Galveston County, and our same crew managed them. We just had to staff up and hire more people, but it worked out really well until, and there's some of the different units. That's on Galveston Island. That's in Texas City. That's a 78 unit. But in 2016, we looked around and we're like, people are paying stupid money for these now. Now everybody and their brother wants to get into the apartment game. And now instead of 24 a door or 20 a door, they're paying 46 to 64 a door. Might be a good time to let them do that, right? And that's exactly what we did. My wife and I, one at a time, we put those up for sale, one at a time. I didn't want to crash my own market because we owned all of them in one county, right? I couldn't put them all up for sale at the same time, but one at a time, we sold those puppies off. Well, that created a challenge. It created a challenge for me, and it created a challenge for a friend of mine, Donald Sutton, because he and Frida were investors in most of our apartment complexes and in a lot of our houses. They were our lenders. So when I sold them off, for the first time, my wife and I actually had cash, right? Before, we were really wealthy on paper. Anybody understand that concept? Right? It looked really good on paper, but not necessarily in the bank account. But for the first time, even the bank account showed it. And then also, all of Donald and Frida's investment went back to them, plus all their earnings. So Donald calls me up one day and says, what are we going to buy now? And I'm like, I don't know. I can't buy apartments for what we were buying them for. We can't buy houses for what we used to buy them for. I don't know. And for several months, we didn't know what we would do. And then I called him up and I said, I know. I know what we're going to do. We start a lending company. And he says, what do you mean start a lending company? Oh, what do you think I've been doing? I'm like, no, I mean a real one, like a big one. Like let's do this thing big. So we started our lending company. Why lending? Here's why. I realized that lending is one of the very few full cycle real estate strategies. I understand there is not any asset that I could sit here and say I could always buy that asset and get a good deal on it. There's no asset. But lending, I can. I could lend in any cycle and still make it safe for me and my investors through something called risk reduction levers. So let me explain that. When you look at lending, there are three major risk categories: the people, the project, and the paperwork. The people, that's your borrower. That's the person that is borrowing from you. So that's a risk. If it's a bad person, you obviously don't want to do a loan to them, right? That makes sense. So we had to put systems in place to make sure we're dealing with good people. The project, that's where Donald got a little benefit when he partnered with me. Because I could look at a project as an active real estate investor and know whether that was a project that we would want to lend on or not. Does that make sense? Because not every project that a borrower brings us is a good project. They all think they're a good project, but when you dig down into it, we have to turn down way more than we say yes to, because they're not all good. And then the third is the paperwork. Now this is where I gained something by partnering with Donald, because I am not the paperwork guy. But that man, he is. He is the paperwork guy. And he could make sure that these deals were papered up and that they were airtight, and that if we ever had to take that property back, we had the paperwork to be able to do it legally. Does that make sense? So when you look at those three risk categories, I talk about something called risk reduction levers. And I had Mark make this for me. I'm an 80s guy, graduated in the 1980s. And back then, in our pickup trucks, we all had these things called graphic equalizers. Anybody from that era, you remember the equalizer where you could crank up the treble or yeah, you had one, I can tell. Yeah. So, well, I kind of picture this graphic equalizer in my mind when I'm talking about risk reduction levers, because risk reduction levers are just things that we can use as a lender that reduce or raise the risk of that loan. Okay? Now, I just had Mark put a few of the most common ones on here. Would you agree with me that if I loaned a higher loan to value ratio to a borrower, that would increase the risk to us on that loan? Meaning, if the property is worth $100,000 and I lent them $90,000, that's a riskier loan to us than, say, lending them $70,000 on a $100,000 property. Well, isn't it cool as a lender that I can ratchet that up and down at will? So if the market is crazy hot, like it has been the last 9 years, and prices are doing nothing but go up, I might ratchet that up a little bit and take a little higher risk. Why? Because the market is covering my risk with appreciation. But if the market starts to turn or wobble or get a little funky or uncertain, as it might be today, I can take that lever and I can ratchet it down and say, I'm no longer going to lend 85% or 80%. Now I'm going to hold to 70% or 65%. Well, that gives me more space that if something goes wrong in that project and I have to take that property back, I can make it right again. The same way with credit score. Would you agree if I lent to somebody with an 800 credit score, I probably have less risk than lending to somebody with a 540. That's common sense. And the same thing with cash on hand. That's another thing that we look at. If somebody's dead butt broke, and then over here I got somebody that's got $100,000 sitting in the bank, which one do you think is the higher risk? Right? So these are all common sense things. Skin in the game. This is one of my favorites. If somebody's on the bubble, we call it on the bubble in the office, that's when my origination staff says, man, I could argue for doing this loan, but I could also argue for not doing the loan. When we have an on the bubble, it comes to me because I'm the referee, basically, right? So it comes to me and I might say, you know what? Yeah, I see it. But instead of doing it at this, I want them to bring another $10,000 to closing. Now they got an extra $10,000 of their own skin in the game or their own money in that deal. Does that make sense? So risk ratcheting that up or down changes that risk in that deal. And then borrower experience, net worth, I could probably put another 5 on that slide too. But all of these things are, as a lender, levers that we can use to ratchet up or down the risk of that loan. That's why I believe lending is a full cycle strategy. It's something that we can do when the market is up. We can do it when the market's down. We can do it when the market's sideways. It doesn't matter because as the market changes, we just go in and change these levers. And it's real simple. Mark has a spreadsheet of our lending criteria. And every time I make a change, he goes in, makes a change, we send it out to our brokers, and it's done. Within a day, I can change anything on there that we need to change. And anything that we had out there before is no longer good, right? So, lending is a constant. Look, I'm a real estate guy. I said that up front. Donald is more the lending guy, but I believe lending is a full cycle strategy. We can do it in any season. Absolutely any season. I would rather be out buying property every day because that's where I have the most fun and I think that's where wealth is made. You can make really good money lending. And half of you in the room, if you're in the growth fund or the income fund, You're lenders. You just use us to do the work. So this is how you do it. So our note funds, we started lending back in 2014, as Donald said earlier. By 2018, we had more loans coming through than we knew how to fund. We had all of our money on the street, on loans. We were making money, but we had more loans coming in and we couldn't fund them. And he's like, so our division of duties, he was the one raising the capital. Many of you had worked with him long before we had the funds. And then he calls me up. He's like, Tom, I can't keep up with you. Okay, I can only raise so much out of El Campo, Texas. Right? You're gonna need to help me here. I said, well, for me to help you, we need a fund. Because I come from a SEC background. I used to be securities licensed before I got into real estate. I said, I want a couple of SEC qualified funds. And he's like, well, that's a pain, but okay. We'd go talk to somebody. And that's when we started the growth fund and the income fund. And then we started raising the capital in the fund in a completely different way than what he had been doing out here locally. And many of you were with him back then. So the growth fund buys notes from Investor Loan Source, primarily from our lending company, that have a piece of real estate as collateral, that have a construction component to it and no current income. So what would that look like? Well, a fix and flip house would meet that criteria. It needs construction and it has no current income because it needs construction, right? Or it might be a commercial piece of property that's being chopped up and sold as pieces. That would we call it a construction component, even though it's not building anything, but going through the soft costs of planning and permitting and chopping it up, that's our construction. And then they can sell it for more than what the overall piece would have brought originally. That would fit into growth fund. Or it might be a piece of commercial real estate where one of our borrowers is taking an old Sears building that's empty and turning it into a gym. Or an old Kmart and turning it into self-storage. We've done those types of deals as well. Those types of loans would go in the growth fund. The income fund, on the other hand, it buys notes from us that have current income and no construction needs. So what would that look like? Well, it would look like a single family rental house. Maybe we have a borrower that did a fix and flip and they thought they were going to flip it, but the market changed. They can't sell it. So they've decided, you know what, I'm just going to keep it as a rental property. And they come back to us and refinance it as a rental property. Now that note has a lot less risk to it, I think you would agree, because it has no construction component and it also has rents. It has income coming in every month. So those notes are what goes in the income fund. If you're not familiar with those two funds, those are the returns over the last several years. I'm not going to dwell on it. So I actually pulled this so I could show you all the facts. I don't like to just give you anything that might be misleading in any way. I pulled this data off of a different source than the chart just to show the annualized returns on the S&P. So the last 1 month was 1.77, 3 month was 7.84. Year to date has been 17.4, right? So you get this. 1 year annualized is 13.97, but 3 year is only 8.8, 5 year 9.1, and 10 year, if you waited a whole 10 years of that up and down, it would have baked out to 10.69, which is roughly what ours is on a flat, just paying out.
No drama.
No drama, yeah. So I thought that was really cool, and that was an addition for tonight. So as you can see, in real estate, there are always profitable strategies. We just have to sometimes be willing to pivot from one thing to another when the market shifts and changes. So when somebody asks me, what do you think the real estate market is going to do? I'm going to say, it's going to change. Yeah, it's going to change. And guess what? So are we. We're going to change too. So lending, we can do that in any market, absolutely any market. But other strategies, not so much. So our favorite questions are this. What's the market offering today? What's it offering today? What's on sale? What should we be selling today, if anything? What should we be buying, if anything? What has the lowest risk at this time? And then a couple of follow-up questions we always ask these two is, what can I scale? Because I won't do anything if I can only just do a couple of them. I want to scale whatever we're going to do. And then Donald's follow-up question is always, what can we build a team and systems around? A team and systems and scaling. That's our two keys to anything that we do. So what I want to caution you though, is if you are a market cycle investor, like we are, you're always going against the grain. You're always being told you're crazy. You're always told you don't know what you're doing. What are you doing? You can't be buying that now. Haven't you heard this? Haven't you read that? Because we're always going against the grain. And we have to be okay with that. And we are. Okay? Confirmation. This tells me that we're on the right track. Warren Buffett is quoted all the time as saying, when others get greedy, I get scared. But when others get scared, what happens? I get greedy. Right. What is he saying? He goes against the grain. Now, I'm no Warren Buffett, but we kind of do the same thing with a different asset. He does it in the stock market. We do it with real estate on a really, really small scale compared to that man. Right. But it's the same exact thing. So I just always try to look past the problems and say, what are the problems that the market has created today, creating with opportunity? Because in every problem, there is an opportunity if you can figure out how to solve it. Would you agree? For example, when nobody could buy my flip, that created a problem. The problem was people were losing houses and they needed a place to live, but they couldn't buy one. What was the opportunity? Build a rental portfolio, a very profitable rental portfolio, going against the grain. So I always ask those questions. What are the opportunities today? There are three, in my humble opinion. The first one is hotel motel. And no, we're not going to do that. Okay? We're not going to do that. But it is certainly an opportunity. We could buy hotels and motels over the past 2 years at a 15 cap all over the country in some of the sweetest areas you could imagine, because COVID killed them. COVID killed the owners of hotels and motels. Now, the reason we chose to pass on that opportunity is real simple. A hotel motel is not just a piece of real estate. It's a piece of real estate with a business attached to it. And it was the business part we weren't interested in. We didn't want to have housekeepers. We didn't want to have bell people. We didn't want to have desk people that we had to manage in multiple locations. So we passed on that. The next opportunity that we saw is office buildings. Like 2001, and how many of you have heard office buildings are suffering across the country? Some of you have read some stories about that. And it's true. It's very true. But it's more true in some cities than others. So the problem with the stories that we read is oftentimes they give you national numbers. And we have real estate brokers in the room that would verify there is no such thing as a national real estate market. Right, Daniel? There's no such thing as a national real estate market. All real estate is local. So are office buildings in San Francisco suffering worse than office buildings in Dallas? Yeah, a lot worse. A lot worse. Yeah, absolutely. Why? I said it earlier. What's the number one driver of supply and demand? Jobs. Exactly. Because people are moving to Dallas. They ain't moving to San Francisco. Okay? Sorry. We don't think that the office buildings have kind of settled out yet. We don't know where they're going to settle out. So we're not buying office. We may at some point, but we don't think that right now is a safe time to jump into that pool. We've looked at it real hard, but we're not quite there yet. Retail centers is the next opportunity. And that's the one we've settled on. And that one we have jumped in, and we have made 2 purchases, and some of you have invested in the second one. And we'll talk about those here in a second, and why we believe that retail centers now is the time to buy, certain types of retail centers. And when I talk about, let me back up. When I talk about retail centers, what I should say, because this is the proper term, shopping centers. Okay? Now we kind of shy away from that term, shopping centers, because the first thing people say is, Tom, haven't you heard of Amazon? Right? People don't shop there anymore. They buy everything online. Well, there's a lot of truth to that. It is changing, but what you're doing when you say things like that is you're painting an entire category of real estate, what we call an asset class, with one brush. Just like saying all office buildings are in a horrible mess, and we pointed out very easily that no, that's not true. San Francisco's in a big mess. Dallas isn't that bad off at all, right? But painting the whole thing with one brush isn't really fair. So what we like are shopping centers with very little shopping. Shopping centers with very little shopping. And I've created a name for them. I like this name better. We don't own shopping centers. We own neighborhood service centers. That's my name for them. Because really, it's a place in the neighborhood that people go to get their services. So the very first one we did, and like we do with everything, Donald and Frida and my wife and I did this on our own without investors because we wanted to test it. We wanted to beta test it. Daniel's the one that brought it to us. He was the broker on the deal. And he brought us this deal and he's like, Donald said you were thinking about buying centers. I think I got one. And I'm like, well, send it over. Let's take a look at it. We looked at it, and at what they wanted, no, it wasn't a deal. It didn't fit my, what? My buy box, right, because we have a buy box for this. We don't just buy any old shopping center that comes to us. We have a buy box. It has to fit, and it's written. And any broker that wants it, I can email it to them. This is our buy box. If you have anything that fits, send it to us. But it's written, so we stick to our own rules. If we don't have rules, we can't stick to them, right? So we looked at this thing and we're like, man, it's in pretty good shape. It's an entire city block in Rockport, Texas. It's got 2 signalized hard corners, meaning there's a traffic light at both corners, right? And when you look at it from the front, how much shopping is in here? Well, this is the Aransas County Courthouse. Not much shopping there. I don't think Amazon's going to hurt us there. This over here is the furniture store. Not very many people buy their mattresses online. I know you can, but not many people do. We've got Pancho's Pizza. This has been there since 1986. We've got the seafood restaurant. We've got the gym. We've got the vape shop. We've got the cookie shop. We've got the coffee shop, the State Farm agent, the doctor's office. How much of this do you get online, by the way? How much of that are you going to buy online that I just mentioned? None of it. Not a single bit of it. So what I love about shopping centers is everybody thinks all shopping centers are bad. But the truth is, shopping centers with big box stores are bad. Shopping centers with neighborhood services that people are going to use regardless, not really that bad at all. One of the other things in our buy box is we want to make sure that the rental rates in this building are low. So if we do have a vacancy, we can backfill it quickly with another tenant. When you look at some of these big shopping centers on Westheimer and some of these real fancy places, you'll see rental rates of $18 a foot all the way up to $30 a foot in some areas. We like rental rates of like $7.50 a foot, right? Because I can backfill that with anything, okay? So those are some of the things in our buy box on these shopping centers. So when we bought it, this was a horrible deal because it's a shopping center, and shopping centers are terrible right now. It was a horrible deal. It was 100% occupied. It had no deferred maintenance. We did pay like $50,000 to paint the front of it just because it looks better. That's all. We just wanted the tenants to know that we wanted to take care of the building. Is when you buy a building, a lot of tenants are worried, oh, how are these new owners going to be? You know, they're out of towners. Are we going to like them? Are they going to take care of things? So the first thing we did was we just went in and spent a little bit of money on that facade, made it look beautiful for them. They loved it. We bought it for $5.2 million. It appraised for 6.7. Boy, everybody got quiet. Y'all are calculating that math in your head, aren't you? 1.5 million in equity day one. Doesn't matter because we're not going to sell it, right? Equity is only good if you're going to sell it, but it's nice. It don't hurt, right? And plus, we have a value add component to it. We have a lot of value add components to it. We know that the courthouse is building a new courthouse, so we knew that at some point they would be moving out and we could backfill it. That was a risk, right? That was a risk because that's 24% of the gross leasable area. That's a big chunk. But we have 2 LOIs on the table that are letters of intent from national credit tenants that want in that center and want to pay us more than the courthouse is. So we're not scared anymore, okay? But that was a risk. We like small towns. We like small towns because there's a barrier to entry. This was 100% occupied, and Alex actually has a waiting list of other tenants that want in the building should anybody move out. And why is that? Because there hasn't been a new shopping center built in Rockport, Texas in 25 years probably, or more. It's too small. And if somebody does come in and builds another shopping center, guess what they have to do? Barry, say that again. Their price will have to be double our price per square foot because with current building and labor costs, you can't duplicate a center like that and charge what we charge our tenants. So even if somebody did come in and build a competing center, they are not going to siphon my tenants off unless my tenants want to pay double. And there's no reason for them to do that if we take care of the building. It's on 35, it's on the main corridor, and you can't get a better street. That makes sense? So, after almost a year of owning that and Donald analyzing the numbers, he called me up one day. He's like, you know what? I've been looking at the Rockport numbers. If you wanted to buy another one, I'd be all for that. That's his way of being excited about something too, just if you don't know him as well as I do. Yeah, that's like excitement right there. And I'm like, oh, okay. So we started looking, and my team found this one in Dayton, Tennessee. And some of you came up to me earlier and asked me about this property, so you'll enjoy this part of it if you're invested in it. So Dayton, Tennessee, it's a town about the size of El Campo or Rockport. About 10, 11,000 people. It's in eastern Tennessee. Some of the most beautiful country there you can imagine. It's a river town. Huge bass fishing town. Huge. Last time I was there, they had a tournament, and I guarantee you there was over 600 bass boat trailers at the park. And the boats were out on the river and lake there. Beautiful area, beautiful country. And this property had already had a facelift. This is the before and after pictures. We haven't had to do anything to it at all. So a dentist bought it. He wanted to get into real estate, and he gave it a huge facelift, brought in some more tenants, filled it up, and then got bored. He had already built a couple hotels, a couple coffee shops, a couple of other things, and he just got bored with this and wanted to sell it. And his cost basis, meaning what he had in it, was so low that he was able to make us a very fair deal, and we're very happy with it. So there's the rest of it. So the numbers on it, that's an aerial of it. Now the exciting part about this was there's, again, a little value add component to this, just like Rockport. You know, with Rockport, we've got what we think are at least 2, maybe 3, what we call outlots. Those are areas that are out between the road and the building, close to the road, that we could put other buildings on, or we could sell that ground for somebody to build a coffee shop or a whatever. Well, those have some value if you could turn those into something. Well, with this one, out parcel number 2, we are actually under contract right now at $1.1 million
Wow.
to the guy that sold it to us, which is hilarious. Okay, out parcel number 1, we have sold an option for $50,000. So we have that $50,000. He can't get it back. It's non-refundable. And he has the right to buy out parcel number 1 for $550,000 at any time in the next 14 months. And he wants to build a hotel on it. Now, with out parcel number 1 or number 2, he's going to build townhomes over there, or he's going to tear down the old car wash that is dilapidated, really. And we were thinking we were going to have to put money into it. Now we don't have to. And he's going to put one of those new tunnel washers over there with some townhomes. And then if he puts the hotel on parcel number 1, what do you think that'll do for traffic in our center for our tenants, right?
Restaurants.
Yeah, it'll bring a lot more traffic in. So those are some of the fun things that we get to do with it. I don't have to do much as far as work or fixing on it because it's in great shape. We do have some roof work that we're going to do to it, but that's about it. So the numbers on it, and we did this in our fund, the equity fund. This is what we call Class A because it's the first one we did. It was 100% occupied. No deferred. There is I should change that slide. That's not true. There's a little deferred maintenance on the roof, but we knew that when we bought it, but not a lot. It appraised for 8.650. Recent renovation of 1.2. He did the whole new facade, painting, striped the parking lot, sealed the parking lot, new LED lights in the parking lot. All of that was done before we bought it, and we bought it for 7.725. which gave us $925,000 in equity day one. So with that, let's go back. There is some shopping. I said I don't like shopping. So somebody might want to call me out on that. Tom, there's shopping. Yeah, there is. But it's discount shopping. I'm okay with that shopping. I'm just not okay with high-end shopping, okay? Why? Because I want stuff that's not only internet resistant, meaning Amazon's not going to hurt us, but I also want stuff that's recession resistant. Because nobody knows what's going to go on next. Some of you have talked to me beforehand and you're like, man, I don't know the direction this thing's going or whatever. And I'm with you. I don't know either. But if it does go south, if our economy does go south, I want to have tenants that are still going to be okay. Can you buy tools any cheaper if you use tools to make a living than at Harbor Freight? No, you cannot. I promise you. You cannot. They will be just fine in a downturn, okay? Can you buy household items cheaper than at Dollar General? Probably not, right? People stop shopping at Target, they move to Walmart in a recession, and the people from Walmart start shopping at Dollar General. That is a true statement. There are studies that show people will move down the chain of discount stores. So I don't mind some shopping as long as it's discount shopping, as long as it's things that are going to be recession resistant. So if you go to another dinner or you go to anybody that is raising capital to buy real estate, I want to give you a lesson real quick to use. People can make things look like anything they want to make it look like. Okay? I was raised in Appalachia. The old fellas, when I was growing up, had a saying. They would say, figures don't lie, but liars sure can figure.
Yes.
If y'all heard that, you know what I'm talking about. Because somebody can be really slick with the numbers and make things look great. I get stuff in my inbox all the time that says 25% rate of return, target 30%. And I'm like, okay, the first thing you need to understand is rate equals risk. Always has, always will. It doesn't matter if you're on the lending side or the investment side or the borrowing side, rate equals risk. So 30% return, I'm kind of worried because that means I'm taking a heck of a lot of risk, okay? But it also might mean somebody's massaging the figures a little bit. So when we do these deals, and if you sit down with anybody else that's raising money from you, here's a question that you want to ask. What are your assumptions? What are your assumptions? Because I told the investors in this deal, in this Dayton, Tennessee deal, that at the end of the day, they should expect a target return of 16.55% over a 5-year hold period. Now, their question to me should have been, what are your assumptions? How did you get there? So Donald, with help from Alex, built me this spreadsheet where all I got to do is fill in the yellow part. It's true, because I'm not a spreadsheet ninja like they are, right? All I got to do is fill in the yellow part. And I walk down through it and I say, do you believe that we could increase the net operating income by 2% per year by raising the rents? Well, if that's reasonable, then okay. I'm using reasonable numbers. Do you think we could get a loan for this, for the leverage part? Well, yeah, I've got a commitment right here. They said that's what it's going to be. And we walk through every one of those assumptions. And then at the end, I say, well, if you agree with all the assumptions, then this is something you probably ought to look at. But if you say, no, Tom, I don't believe any of that, or I don't believe a couple of those assumptions, this is not something you should invest in. And not just with us, but anybody that is raising money from you to buy real estate, you better ask their assumptions. And I put this in what we call our pitch deck. That's the deck I send any potential investor when they're investing with us. You get our internal spreadsheet. You can see exactly what all of our assumptions are. And you can call me out on any number there that you don't think is reasonable. What I want in every deal we do is I want you to look at me and go, you couldn't suck that bad. You've got to be able to kill that number. Right? Great, because I'd rather underpromise and overdeliver and do the opposite, okay? When we did this sheet, for those of you that are in this deal, you know we did not account for any of the outlots. Remember that? Well, guess what? That's a bonus. So we're already going to overperform those numbers. So that's our strategy on the equity fund. We buy stabilized assets, stabilized, meaning they're already full. We don't have to fill them. They're already full, that are in good condition, that have very little shopping. And the shopping they have is discount shopping in good areas on good corners of America. That's our buy box. It's more detailed than that, but that's the Reader's Digest version. So if you're interested in anything like that, get with Jeff or Alex. We want to put you on our list. Somebody asked me earlier, what's the next one? What's the next one? You got another one? I don't. I didn't put this together to sell you anything. I have absolutely nothing to sell you. I have no new deals. We have some that we're working on though. So get yourself on the waiting list. And then when we do have deals, here's how it works. Anybody that's in the Dayton, Tennessee deal, they get first dibs. They get 2 or 3 days head start over everybody else. And then anybody that's in the income fund and the growth fund, they get a few days head start too after that. And then if it's not filled, then we open it up to anybody that's not already invested with us. So we try to take care of the family first, everybody that's already here, we're going to take care of you first, and then we go from there. So you are welcome. You are welcome. So I always get this question too, so we'll just get it out of the way. Why now? Why are you buying these now? You said earlier, Tom, that prices are still falling in most commercial assets. Remember I did say that. It's true. And they are. Well, why are we buying now? Why wouldn't we wait to the bottom? Anybody answer that for me? We don't know where the bottom is, exactly. So what we do is we build a buy box, going back to that silly term again, we build a buy box that works, and we buy everything we can that fits that box while we're in the downturn and back up the other side until the market leaves our box. Remember in 2010, the single family market left our box and we weren't able to buy any more houses at that deal, in that box. The same thing in 2012, the apartment market left our box. We're not going to chase it. We're not going to change the box because we can't get a deal. We just change what we invest in. Does that make sense? So we want to buy all the way down. We want to buy all the way back up until the market leaves our box. And when it does, we're done. And what we got, we got. We anticipate holding these deals for about 5 years. I say 5 years because as I study this and I go back to the 20s, when I look at the charts, I've never seen a market that I couldn't do a strong flip of a piece of property in a 5-year period. Now, is this one going to be different? Who knows? But there's never been one. Most are actually going to be about 3 years. Our apartments were about 2.5 to 3. Okay? So what we're going to do is we're going to wait until the market does what? It tells us to sell these. When people start overpaying, we're going to let them.
Yes.
We're just going to let them. And we'll start selling them off. Does that make sense? Okay. So, high cost of inaction. I know a lot of people are scared right now. I talk to capital guys all across the country, guys that are used to bringing in $5,000 a month, they're bringing in $1,000, or $5 million a month, they're bringing in $1 million a month. Or guys that are used to bringing in $3 million a month, they've got $1 million a month going out in outflow. It's tough for the guys out there running syndications, syndicating apartment complexes and other commercial assets, because people are scared. They're sitting on the sidelines. They're doing this with their money. They don't know what to do with it. But I want to show you the cost of inaction. If you have what I call lazy money, that is money that is not getting you a reasonable rate of return for the current market. This is how much it costs you. If you were just holding out for a 12% return, let's say, Tom, I don't know anything I could get a 12% return on, and that's what I'm waiting for. I want 12% on my money. And you hold your money on the sidelines for 2 months, then you find that magical 12% deal, and you invest it for that 10 months remaining. You actually brought your annualized return down to 8.33%. So you really didn't get your 12. You got 8.33. If you hold it on the sidelines for 3 months, you've dropped your APR to 7.5. And if you hold it for 4 months, you've almost cut your 12 in half to 6.67%. That's the cost of inaction. So if you've got lazy money sitting on the sidelines, talk to Donald, talk to Jeff, talk to Alex, and see how you can get that money working for you. We've got short-term options. We've got longer-term options. There are a lot of options they can share with you, but you don't want the money sitting and not getting you anything, or sitting in a bank and not getting you much more than a bank account yet. So, don't let fear and lazy money keep you from your goals. Thank you very much for coming out tonight. I'll open it up to a few questions if anybody would like to. Thank you.
Well, I hope that was beneficial to you, and I hope that you took away from that when things are down, that doesn't necessarily mean it's all bad, right? Market cycles moving up and down are actually beneficial to those of us that use them to build our portfolio and build our wealth. So if you'd like to learn more about our growth fund and our income fund, those are our two real estate note funds, or the shopping center projects that we do, feel free to reach out to us. We'd be happy to put you on our shopping center waiting list for the next deal as it comes up. And of course, the income fund and the growth fund, our note funds, are always available as those are evergreen. So we're always accepting new investors in those. So reach out to us with any questions that you have, and we'll see you on the next video.